Welcome to this explainer. Today, we are taking the massive, abstract world of foreign exchange, better known as forex, and breaking it down from the macro scale of global finance right down to the terminal on your screen. If you've ever tracked currency flows or watched institutions navigate this ecosystem, you know it's an absolute beast. So, let's jump right into how this market actually operates. $6 trillion. Just wrap your head around that number for a second. That is the average daily trading volume we're talking about here. To put that staggering scale into perspective, it's roughly equivalent to trading the entire GDP of Japan every single day. It's exactly this defining characteristic that makes Forex the absolute largest, most liquid financial market in the world. And that extreme liquidity, it means capital flows rapidly enough to execute massive positions with near zero hesitation. So moving on to our first main section, the market that never sleeps. To understand how a market actually handles $6 trillion a day, we really have to look at its architecture. We're moving away from the physical trading floors of a traditional centralized stock exchange. Instead, Forex relies entirely on a decentralized, over-the-counter digital bazaar. Now, what this means in practice isn't just the lack of a central checkout. It fundamentally changes liquidity routing and latency. Transactions are happening directly and electronically across a vast, interconnected network of banks and brokers, which makes your execution speed heavily dependent on the specific liquidity pools you're tapping into. And because there's no single physical location tying it to one time zone, this electronic network is open for continuous trading. It operates 24 hours a day, 5 days a week, creating this seamless, rolling wave of global liquidity. As the trading day closes in New York, it's already opening in Sydney and Tokyo, before eventually handing off to London. This continuous cycle means that reactions to global economic news, like, say, an unexpected rate cut, happen instantaneously, whether it's high noon or 3 in the morning. Which brings us to our next section, how Forex actually works. In this space, a currency's value never really exists in a vacuum. It's a constant tug-of-war. You're always trading currency pairs, constantly assessing the dynamic tension between risk-on and risk-off assets. The exchange rates you see are immediate reflections of shifting macroeconomic currents driven by supply, demand, and global events. A sudden spike in crude oil, a surprise inflation print, or escalating geopolitical tensions, those are all instantly priced into these comparative valuations. Consider the Euro/USD, for example. This is the undisputed heavyweight of the market. When you trade this specific pair, you aren't just looking at technical charts. You are effectively trading the European Central Bank's monetary policy directly against the Federal Reserve's latest inflation fight. It's literally the economic health of two massive global powerhouses distilled into a single, fluctuating price point. Okay, let's shift gears to our next section. Who plays the game? So, who is actually on the other side of the screen making these $6 trillion worth of trades? It's a highly diverse ecosystem. At the top, you have central banks, commercial banks, and massive hedge funds creating the large macroeconomic waves. And then you have the individual traders and brokers who are trying to successfully surf those waves. Because you have institutional giants moving billions right alongside individual algorithms, it guarantees that unmatched liquidity we talked about. You can almost always find an immediate buyer or seller. Moving right along to the next section, who sets the rules? Since we've already established that this is a global, decentralized network operating around the clock, you might logically be wondering, is it just the Wild West out there? Well, because there is no single global sheriff, a patchwork of national authorities steps up. In the US, the CFTC ensures fairness. Over in the UK, the FCA takes point. And in Australia, it's ASIC, enforcing local compliance. These regional bodies mandate clear reporting and crucial investor protection measures. Meanwhile, on a global scale, heavyweights like the BIS and the IMF influence broader stability. So decentralized absolutely does not mean unregulated. Let's move to our final layer, tools of the trade. Bridging the gap between high-level theory and how you actually plug into the system, we have the platforms. Impartially looking at the top-rated gateways into this market, platforms like Exness, RoboForex, IC Markets, FX Pro, and XTB consistently pull impressive 4.7 and 4.8 out of 5-star ratings. These brokers provide the essential infrastructure, security, and access points for traders. They act as the critical gateway, offering distinct advantages whether you require Exness's high leverage and fast execution or RoboForex's low commissions and wide asset availability. And when looking across these top platforms, and others highlighted in the source data like 8cap, a really clear pattern emerges of what successful execution actually demands. You need low and competitive spreads to minimize friction. You absolutely need blistering fast order execution speeds because remember, this market moves in milliseconds, and slippage can easily destroy a strategy. Add in the necessity for high liquidity, leverage options, clear transaction reporting, and advanced technical suites like MetaTrader or CTrader, and you have the definitive toolkit for navigating this space. We've mapped out the $6 trillion liquidity pools, the continuous decentralized architecture, the players, and the specialized platforms built to execute the trades. Now that you've got a clear view of the mechanics to finding the world's most liquid digital bazaar, the only question left is, in a $6 trillion daily market that never sleeps, what's your next move? Thanks for joining me on this explainer, and I'll catch you next time.